Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode is New Construction Incentives for Investors.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today's podcast is about new construction incentives for investors. Today, we'll explore a relatively hot topic in the consumer real estate market, but I want to do it from an investor's perspective. That would be this new construction market and how leveraging developer incentives can make the numbers work. I don't spend a lot of time coaching investors on acquiring new build real estate to invest in, but I have, on the brokerage side, helped many clients over the years become investors because they only wanted to invest in new construction. So we had to take a look at how can we leverage this in order to make the numbers work and make this a viable means, especially in a market like that I'm in here in the Phoenix market, an appreciation market. This might be a much tougher strategy in a cash flow market versus an appreciation market, but we'll be dealing with most of the large metro areas in consideration for what we talk about today. And the landscape has changed when it comes to new builders. Just drive around your area. In my primary market here, we see many new home communities coming up. And I get it. Builders were relying on incorrect data coming from the Fed, the CBO, and the Labor Department, and it painted a picture in 2024 that really didn't exist. The Fed's willingness to lower rates last fall was an incentive for new builders to go forward with enthusiasm, much of which has died down with the Fed's rate struggle with the Trump administration. The auditing of the economy under the Biden administration hasn't been good. The job numbers were off by millions. The inflation numbers were off. Everything about the economy that they kept telling us that was so good was based upon faulty numbers that have now in the first 2 quarters of 2025 have been revealed as being bad. Now, you think about it, if you're a new home builder and you're building and developing communities based upon the information that you have, and then you find out it was all wrong, it puts you really in a tight situation. Buyers have been hesitant about entering, the new build market. In fact, as any market. Obviously, as investors, we know the, 2020, end of 2022, 2023, and 2024 were really hard markets. Rates are still comparatively high considering the cost of new construction. So what does that mean as an investor, and how can we leverage this scope? Well, many builders are motivated to move inventory. That's always good. Anytime you have somebody motivated, whether it's a seller or a buyer, that means on the other end of it, there's opportunity. So let's break down some of these aspects. The fact is, I want to break this down into 3 key topics that are tailored for investors. Number 1 will be builder incentives and their impact on cash flow. Number 2, financing strategies, rate buydowns for investment properties. Number 3, smart home and sustainability upgrades as they add value opportunities. So point number 1, builder incentives and cash flow impact. First, let's cover builder incentives. A lot of people who haven't been in this space don't realize that from time to time, builders will offer incentives. Because of the market that we're in, builders are competing to move this inventory, especially if they've overbuilt spec homes. And a lot of them came in, building spec homes, and a lot of them, that's their market. They build spec homes, they saw off the spec homes, but they also use them as model matches so people can build, custom properties in their market. And taking advantages of the incentives can directly improve an investor's cash-on-cash return by reducing upfront costs and enhancing the property appeal. Some of the more common incentives that builders are likely to offer would be closing cost concessions. Closing cost concessions simply are the builder giving you money that you would otherwise have to spend. And I've seen builders provide up to 3% of the purchase price of the asset. So if you're buying a $500,000 new build, that's $15,000 that they are providing you to cover your costs of acquisition. The nice thing is it reduces the out-of-pocket investment, keeping your cash in your bank where you can maximize and leverage it on other deals. I always like it when other people are paying my expenses. It doesn't matter what niche or market I'm in. I love it when other people are paying my repairs, when they're paying my closing costs, those type of things. Next is free upgrades. In addition to closing costs, builders are incentivizing by providing upgrades. See, when builders are faced with these slow-moving inventories, they become more generous with their upgrades. So counters, flooring, landscape, and appliances are all options that become available potentially for you to negotiate. Some of these concessions, the builders advertise, trying to draw people in. Some of them are just negotiated at the table. You start asking. And I've had a builder who wasn't offering any concessions give up to $30,000 just in concessions because we started asking questions on behalf of the investor of what we could get if we did X, Y, and Z. So these can be important for demanding higher rents compared to other similar properties that will be in the community where you're buying in. So if your house has the better upgrades, the more modern attributes, then tenants are going to be more likely to want to live in your home and pay the rents that you're asking. Also, a builder may be willing to provide a design center credit where you can select furnishings and finishings that you feel maximize the income potential of a property. But here's an investor tip. If you focus on spec homes that are complete or nearly complete, you may be able to negotiate the best concessions because they've already got money invested into that property. It's sitting there. It's just like when we flip houses. If you're a flip investor, you've got money into it. You're a little bit more negotiable if that house is not moving. You want to get rid of it, get it off your books so you can put that money into your next project. But if a builder is too far along in a project, you may not be able to get design center upgrades. So that's kind of the trade-off with that. New builders are no different than us when it comes to investing. They want to offload their carrying costs as quickly as possible, just like we do with flips, your rental homes. You don't want your rental home sitting vacant, so sometimes you'll offer somebody maybe a little bit of an incentive up front. You see apartment complexes do it all the time. If you sign a 2-year lease, they'll give you the first month free. So it's incentives, and new builders are the same way. They want to keep this money turning when the market is slow and when buyers aren't overwhelming them. You'll see them change when the buyers start coming back and things pick up. They'll start offering incentives. Sometimes you can stack these incentives, which will bring immediate equity and lower acquisition costs for you. But often you have to act fast because incentives are offered because they're struggling to sell stuff, but they have a great sales day and they move a bunch of properties in one day. The builder concessions may vanish overnight. And so if they're offering it to you, you may not have a week to sit on it and wait to make the decision. You need to be ready to pull the trigger because the incentives could go away pretty quickly. Here, point number 2. Let's talk about financing and rate buy downs. There are a couple ways to acquire these assets, just like the other stuff that we purchase. You can use your own money or you can use other people's money. And I love using other people's money. So I'm going to focus on OPM. But if you're paying cash, you may be able to turn the incentives being offered into just pure discounts on your acquisition if you're a cash buyer. But first, we should briefly, discuss mortgage rate buy downs because this has become really big over the last couple of years on the resale side, but it's also in the new build side of things. Since interest rates are still elevated compared to a few years ago, builders have begun offering rate buy downs as incentives to attract buyers to take advantage of the inventory that they have. And this can be a big incentive for properties that you plan to hold long term. If you're getting in, and the new build investors that I have worked with over the years, most of them are looking long term. They're looking for the appreciation, and they're looking so that they don't have any maintenance or issues to deal with, and they're going to hold these things, long term. So there are a few plays here. There's temporary rate buy downs that could lower your rate for, we'll say, 2 to 3 years. It reduces your monthly payment early on. This can be a bridge to a future mortgage rate cut that still seems on the horizon. So you're taking the discounted rate now, knowing that it only is going to last for a short period of time, and then you're going to begin shopping that mortgage as rates begin to drop. And when the market rate gets even to or even below, and the reason I say even to, because at some point you're going to want to lock in that savings. And so it's nice when it gets below, but if you have any concerns, if the market starts to change and it looks like rates may be going back up, you're going to want to lock in when you get even to or below your buy down rate to transition into permanent lower financing. I've done this on a commercial property with a huge win. Was able to take advantage of the buy down rate and then refinance it when rates begin to drop. The other option is a permanent buy down. Instead of a temporary one, you go right out of the gate and you do 15, 20, or 30-year permanent buy down. You may give up a little bit on the front end to get this. So you may have to give up some other concessions. The buy down might not be as great as it is with a short-term one. You give up a little on the front end generally. Don't always have to, but generally you do. And the rate may not be as great as the temporary buy down. But if you think rates may be heading up in the near future, this is a safe haven. You get below market rate, and it locks you in case rates do go back up. The buy downs work because the builder is paying the loan points to secure the below market rate for the loans. They're actually paying their lender points up front to reduce their interest rate. And this can be either on a short-term or long-term buy down, but it can boost your net operating income right from day one. For example, if market rates are at 7% and the builder, through their lender, they offers 5.5% on it, so it's a 1.5 below market, and they do that for the first or even for the full term of the loan. On a $400,000 loan, you could save $500 to $700 a month. And that's where you can develop some real good cash flow on your rentals, and that money can be redirected to upgrades or whatever it is that you want to do, or additional acquisitions if you're leveraging more than one of these properties at a time. There is a drawback that you may encounter. These deals often require you to use the builder's preferred lender. So if you have a preferred lender, somebody you've worked with before, somebody you're very confident in, it may not be possible to use them. It may not be a deal breaker, but you need to run the numbers and you need to run it by your lender and see what they have that they could do to potentially match what the builder is offering. I've actually had lenders that when you take the builder's money to them, they get very close, but their overall costs are less and the numbers pan out that it's better to use non-builder money, but you use it as leverage in negotiating in the deal. So there's some options here that you can look at, but you want to compare their terms to your own lender. Especially if you're doing a portfolio loan or a debt service cover ratio option on the property, you want to look at all of those things. Builders are looking for smooth closings, so they'll often throw in these extra perks if you use their financing because they're confident in their lender. They're pretty sure their lender will get the job done. All right, point number 3, smart home and sustainability upgrades. Now, personally, this is not my secret sauce to investing. I'm not a green energy, sustainability. We do some automation in homes, but we don't focus a lot on that because it's just not our niche in our marketplace. However, I have investors who do. And they've leveraged this and they sell this. It's part of their secret sauce because not everybody out there is doing it. So, you can leverage this, but I think it's worthy of discussing. So that's why I want to talk about it. Smart home and sustainability incentives are a growing trend. These upgrades can, set your investment apart in a competitive rental market. So they can give you that little unique thing that the property down the road or in the community doesn't have that sets your property apart. Tenants, especially the millennials and the Gen Z, they're willing to pay premiums for tech-aware and eco-friendly properties because it adds some value to them. And so some builders have started offering these as potential upgrades to their property. And so you may be able to work some of your incentives to pay for some of these or just purely just add it on, as it will add value to the home overall. So the first, I guess, notable one that we're all probably pretty aware of by now, and that's solar credits. Solar systems can cut the overall utility cost and can boost your operating income depending on how you're renting your properties, what your model is. And so right now, may not last for a long time, there are still solar credits. And it can make the house more attractive to a tenant knowing that there's solar there. So let's just say that the house that you're acquiring, the average monthly power bill will be $200 without any green energy, but with solar, it'll be $70 a month. So a tenant looks at that as $130 savings. You may be able to build that on the back end by increasing your rents because of this great feature that you're offering your tenants. Be aware that some of the federal incentives, though, are going away in the solar space, and I expect to see most of those gone within the next couple years, at least in the current environment we're in. The other thing that people are looking for is EV charging stations. Now, I don't need it because I don't have any EV cars. My son was, in fact, as we wired when we remodeled his house, we wired it so that he can have an EV charger. He was going to do I don't think he's purchased it yet, an EV bike, motorcycle that's battery powered, and so this has become pretty commonplace, though, especially inside the metro areas. I mean, it's a big upgrade for attracting tenants in a lot of the metro areas because they have higher densities of electric vehicles. They've really adopted this technology. So it can add a rental boost, and it's going to continue. I think the density inside some of the larger metro areas are going to continue to lend towards electric vehicles. And again, it's not my thing, but we're talking about an investment in a new home and may be worth putting in at the time that you're acquiring the property to give you a standout over other properties in the neighborhood. The other thing that you can do is smart home packages. So smart lights, smart thermostats, smart security systems, all that can be remotely controlled. And it gives your tenants a more home ownership feel. They don't have to actually be there to be able to control their home. They feel like they have some control over the property. They can see the things that are going on, the temperatures. They can get the home. So for instance, in Phoenix, you may turn the temperature up when you leave for a week to 85. But the day before you're coming home, you may want to turn it back down to 72, 4, whatever, and cool the house back off before you get back in. And it gives you that feel of ownership, and tenants really like that. Besides that, when you go to sell it, some of these features are benefits to buyers who are looking to acquire the home. It gives you the ability also to monitor tenant activity for property management purposes. I'm not talking about spying on your tenants, but I'm talking about being able to see energy uses and those kind of things. I have a rental property that we include all the utilities on, and it gives us the ability then to monitor and manage why is this up this month, why is that up, and you can see the trends and help to track the averages. The other thing is energy efficient appliances. They've been around a long time. Some of the new Energy Star ones can really lower operating costs. They got green certifications, which then you can advertise and sell as being a green home. It can unlock some tax credits that are still available as we go into quarter 4 of 2025. There's still some current tax credits available. And a lot of times there's special financing. So if you're not building it into the purchase of the new build and you're not getting an incentive, but there may be some special financings for some of these green certified appliances and such. So they're definitely worth looking into. So these upgrades, they're not just bells and whistles. They're actually value add opportunities for you. A smart home can command 5 to 10% higher rents, and energy efficient features reduce turnover by appealing to long-term tenants. So you think about that. If somebody feels that their energy costs are lower, they may be willing to pay you a little bit more and stay in the home because they don't think they'll find something better in the marketplace. Additionally, green certifications have the potential of increasing the resale value for sustainably focused buyers. And that may be something that you want to focus on for down the line. So let's wrap this up. As we enter quarter 4 of 2025, there are still builders offering incentives that may not be even advertised, but as a savvy investor, you may be able to leverage. Things like closing costs, cover upgrades, rate buy downs, smart and green tech, that all add to long-term value. That's all I have for this episode. I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Check out our previous episodes and related real estate investing topics. I invite you to subscribe today and become part of our growing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.